Hello students, welcome to Let's Learn. Today we are looking into the problem of depreciation. It is an essential concept in finance and accounting that impact assets, taxes and business decisions. In this video, we will break down the depreciation into small, simple and manageable steps and show how to solve depreciation problems with ease. Whether you are a student preparing for exams or a professional looking to sharpen your skills, this guide will help you to understand this depreciation. Now, make sure to have a calculator handy and feel free to pause and rewind as we work through each step. By the end of this video, you will be ready to tackle any depreciation question with confidence. Let's start with this question. Here the question says a company whose accounting year is a calendar year purchased on 1st April 2004 a machinery costing rupees 3 lakhs. It purchased further machinery on 1st of October 2004 costing rupees 2 lakhs. On 1st of Jan 2006, one third of the machinery installed on 1st of April 2004 became obsolete and was sold for rupees 30,000. Now the depreciation is being written off on fixed installment method at 10% per annum. Prepare machinery account as would appear in the ledger of the company for the years 2004 to 2006. Now let's understand the question. Here the company is following a calendar year. That means the calendar starts by 1st of Jan and ends by 31st of December. So our starting of the year will be 1st of Jan and end will be 31st of December. Now this company has purchased machinery on 1st of April 2004 that cost it rupees 3 lakh. Then again the company has purchased the second machinery, purchased further machinery. That means additional machinery or another machinery they have purchased on 1st of October 2004. That means it is a second machinery they are purchasing that cost them for rupees 2 lakh. Now on 1st of these two machineries were purchased in the year 2004 and 2005. There is no transaction of purchasing or sale. Simply will charge the depreciation in 2005. Coming to the 1st January 2006, one third of the machinery installed on 1st of April 2004. When we look at the date, 1st of April 2004 means machinery 1 that became obsolete and was sold for rupees 30,000. And it is not the full machinery, they are selling only one third machinery installed for rupees 30,000. Now the company is following a fixed installment method and the depreciation rate is 10% per annum. Now here we are asked to prepare the ledger of the machinery for the years 2004 to 2006. Now coming to the solution, we are preparing a machinery account here. So we are purchasing the first machinery on 1st of April 2004 as the machinery is coming in and cash or bank is going out. So machinery account data to bank. First machinery purchased on 1st of April 2004. On debit side it is written as to bank and the amount of purchase or the cost of the machinery is 3 lakhs. In the same year in 2004, the company is purchasing the second machinery on 1st of October 2004. So again the same machinery is coming in and bank is going out. So machinery account data to bank for the second machinery and the cost is 2 lakh. Now any other transaction is not there in the current 2004 year. So we'll be going to the end of the year, that is 31st of December 2004. Here on credit side we'll be charging the depreciation as by depreciation account. Under that for machinery 1, 22,500. How come? We can say that they are following the original cost method or fixed installment method. So depreciation will be calculated on the original value of the machinery. Here we'll see the working notes for this. The machinery 1 was purchased on 1st of April 2004 and the value is 3 lakhs. Here like this you can calculate the depreciation. 3 lakhs into depreciation percentage, that is 10 by 100, into months we are using this machinery: April, May, June, July, August, September, October, November and December. Here that means we are using the machinery for 9 months out of 12 months. Here now we'll calculate. Here we are calculating 3 lakhs into 10 by 100 into 9 months used out of 12 months. So the value for depreciation 1, the value of depreciation for machinery 1 is 22,500. It's 22,500. Here in this account you can see the value of the machinery 1 for depreciation value for the machinery 1 is written it as 22,500. Now charging the depreciation for machinery 2, we are purchasing it on 1st of October. So here the machinery 2 was purchased on 1st of October 2004 and the value for that is rupees 2 lakhs. The value for the machinery is 2 lakh and the depreciation percentage to be charged is 10 by 100 into, now you will see for how many months we have used this machinery, that is October, November and December. That means we are using the machinery for 3 months out of 12 months. Now we'll calculate this on the calculator. Here the cost of the machinery is 2 lakhs into 10 by 100. We are using the machinery for 3 months out of 12 months. So the depreciation for machinery 2 amounting rupees 5,000 by the end of the year. So we will be charging here the depreciation as 5,000. Here you can see that under the depreciation for machinery 2 we have charged the 5,000 rupees, 22,500 depreciation for machinery 1 and 5,000 depreciation for machinery 2. So the total depreciation cost 27,500 for both the machineries and total on debit side is 5 lakh. Deducting the depreciation amount 27,500, we have a balance of 4,72,500 that belongs to both the machineries. Here we are end with the for the year 2004. In the next year on 1st of Jan 2005 we are starting with the balance, previous balance, that is 2 balance brought down, that is 4,72,500 for both the machineries. Here we are charging the depreciation on original cost method or straight line method. So we don't have any purchase, sale or any other transaction, so directly we'll go to the closing of the year, that is 31st of December 2005, and we'll be charging the depreciation on both the machineries. Under the head by depreciation account, for machinery 1 we will be calculating on original cost 3 lakhs into 10%. The depreciation amount is rupees 30,000, and for machinery 2 it is 2 lakhs and the depreciation percentage is 10%. 2 lakhs into 10%, we got a 20,000. So total depreciation for both the machinery is 50,000 in the outer column. Again we have a total of 4,72,500 on the debit side. After deducting depreciation of 50,000, we have a balance of 4,22,500 on the credit side that will carry forward for the next year. Coming to the year 2006, on debit side, we will be writing the date 1st of Jan 2006. To balance brought down from the previous year 4,22,500. Now we have a transaction of sales here. Here in the question, when we see on the third line, on 1st of January 2006, one third of the machinery installed on 1st of April 2004 became obsolete and was sold for rupees 30,000. So here we are not selling the whole machinery, we are selling only one third of the machinery installed on 1st of April 2004 that became obsolete, and we are selling it for 30,000 rupees. You should remember that whenever we are selling a machinery, we will be posting the three entries here. One entry for the depreciation if you are using a machinery for any months. Second entry will be for bank, that means when we are selling the machinery, we are receiving certain amount for that, and the last entry will be for P&L account. If we receives a profit, we will be writing it on a debit side, and if we are bearing any loss, we will be writing it on a credit side. So these are the three entries whenever we are selling the machinery we have to post. The first one is the depreciation to be charged on the machinery to be sold, and second one is the amount we are receiving on sales of the machinery or any asset, or third will be the P&L account on selling that asset. What we are going to find it out as, are we going to receive a profit or we are going to bear a loss. So now here we are selling the machinery 1 on 1st of Jan 2006 itself. So that means we are not even using a single day the machinery in the year 2006. So there is no need of charging any depreciation. Otherwise it was used for n number of months, we have to charge the depreciation for those months. Here we are not charging any depreciation, but we'll be giving the here we are not charging any depreciation, but we have second entry, that is after sales we are receiving certain amount, so we are posting that by bank we are selling it for 30,000 rupees. Now coming to the next, to find out the profit and loss, we have to see what is the here we have to see the certain notes here. We are actually calculating the depreciation on the original cost method. So here loss on say we are finding out whether we are getting a profit or loss on the sale of this machinery. So actual cost what we are selling for one third of the machinery, it will be 1 lakh. Like the total machinery cost 3 lakh rupees into one third. Here one third for 3 lakhs comes as 1 lakh rupees. We are deducting the depreciation for previous 2 years, that is 7,500 and 10,000. For here we can say that 22,500 into 1 by 3 plus 30,000 into 1 by 3. So both the depreciation for 2 years will come as 7,500 and 10,000. So combinedly depreciation for one third machinery is 17,500. When we deduct this depreciation, we got a value of a machinery as 32,500 in the third year. Here the machinery was sold for rupees 30,000. That means the value of your machinery is 82,500 and you are selling it for 30,000. That means you are bearing a loss here on the sale of one third of machinery. This loss is posted here. Here you are bearing a loss of 52,000. Coming to the account, we are not providing the depreciation. By bank, the amount we have received on sale, then we are bearing a loss. So if we are writing the loss here 52,000, it should be 52,000 I guess. 52,500. So no, here should be 52,500 in the loss on sale. 82,500 minus 30,000, 52,500. So here, as we have sold the machinery, 1/3, here are the entries for that. But after this, we still have 2/3 of the machinery of machinery 1 with us. So here we are going to charge the depreciation on that remaining amount. We are writing here by depreciation. Again, here we have 2/3 of machinery that cost 2 lakh rupees. 2 lakh into 10 by 100 that we are using for the whole year. This is the machinery 1. Then after that we have a machinery 2 with us that cost again 2 lakh rupees. That is the original cost of the machinery. We are going to charge 10% depreciation on this also. So the amount for machinery 1 is also 20,000, and for machinery 2 is also depreciation amount is 20,000. So total comes to 40,000. Here in this account you can see by depreciation for both the machineries 40,000. Now all the transaction has been completed. Coming to the debit side, the total of your machinery account for the year 2006 is 4,22,500. Deducting the amount 30,000, 50,500 and 40,000, we are remain with the balance of 3 lakh rupees. So we'll be writing by balance carried down 3 lakhs. We are closing the account for the year 2006. In the year 2007, as we have machineries with us, we cannot close the account. We'll carry forward the amount in the year 2007, and we'll be posting here on 1st of January 2007 as to balance brought down 3 lakh rupees. With this, we are done with the question, as they are asked us to prepare the accounts from 2004 to 2006. We have prepared 2004 to 2006. As we have machinery with us and they are still in working with the company, so we cannot close the account. We have posted the balancing figure to the next year. Hope you have understood the problem. If you have any doubt, you can please clarify it by commenting on the in below, so that I can answer and clarify your doubts. If you found this video helpful, don't forget to like, share, subscribe and hit the notification bell so you don't miss our future lessons on key finance and accounting topics. Now let's dive in and make learning easy with the Let's Learn. Thank you, and we will meet you again in the next video of this channel.